I think if the world didn't have so much false optimism, I think the gold price would be, quite a bit higher than it is now. Probably, maybe $200-300 an ounce higher than it is. I think we're going to get there. I think it's just going to take a little while for the illusion to fade and for people to wake up to the reality of the problem. The main trigger is not going to be geopolitical. It's going to be what happens in the U.S. economy. I think if the U.S. economy goes into recession officially and the Fed goes back to QE, I think that's going to be the biggest positive catalyst for gold. I think we'll get above 3,000 next year.
Gold prices have shown resilience, climbing even as U.S. real yields rise. The precious metal faces a headwind, with yields on the 10-year note up 3 basis points to 2.248%. However, analysts remain optimistic about its long-term prospects, citing potential catalysts that could increase prices. PeterSchiff, chief economist and global strategist at Euro-Pacific Asset Management, identifies the U.S. economy as the key factor for a significant gold rally. He suggests that if the economy officially enters a recession and the Federal Reserve resumes quantitative easing, gold prices could surge, potentially surpassing $3,000 an ounce next year. Despite recent challenges from higher U.S. rates, gold maintains a bullish long-term trajectory. Geopolitical tensions continue to provide additional support for the metal, which remains a haven during times of uncertainty. Schiff also notes that gold had a strong year globally, hitting record highs in currencies like the euro and pound. Gains in U.S. dollars, however, were limited due to the dollar's strength, driven by optimism about the U.S. economy during Trump's presidency, which likely suppressed gold prices by $200 to $300 per ounce. The market's exceptional performance has drawn attention, with Daniel Gali, senior commodity strategist at TDS, highlighting the rarity of such strength outside a U.S. dollar bear market. A significant shift in investor sentiment fueled this performance. Gold transitioned from underinvesting at the start of the year to reaching an extreme position size by the U.S. election night. Additionally, vigorous physical buying activity, particularly in the first half of the year, was bolstered by increased central bank purchases. Make sure to tune in for our expert analysis. Don't miss out on future content. Hit the subscribe button and turn on notifications to stay in the loop.
Well, it's been a good year for gold. Gold has pared its gains a bit in dollars since Trump was elected, although it's gone on to make new record highs in other currencies. The Canadian dollar, the Australian dollar, the euro, the pound. We've seen record high gold prices after Trump was elected. And that's because, the dollar has benefited from a lot of the false optimism surrounding the U.S. economy and how it's going to fare relative to the rest of the world based on Trump. And I think if the world didn't have so much false optimism, I think the gold price would be, quite a bit higher than it is now. Probably, maybe $200-300 an ounce higher than it is. I think we're going to get there. I think it's just going to take a little while for the illusion to fade and for people to wake up to the reality of the problem.
So in summary, you're saying eventually the gold price and the S&P 500 are going to decouple and not going to move in lockstep further high or higher anymore?
Well, they could move in the same direction. I just think gold will move a lot faster. So in real terms, the S&P will be going down. Look, the U.S. stock market, no matter how you look at it, is very overvalued. Now, the only way it's not overvalued is if you say, well, the dollar is going to crash. And so, priced in what the dollar is going to be worth in the future, maybe it's not overvalued, which could certainly be the case. But in terms of gold, in terms of how many ounces of gold you need to buy the S&P versus what the earnings are of the S&P in gold. So how many ounces of gold is the S&P earning right now versus the price of the S&P in gold? The PE is much too high, based on where it historically would be. And so I think that real U.S. stock prices are coming way down. What happens to nominal prices is harder to say, and I think even less relevant, because what matters to investors is not what their stocks are worth on paper, but what the value of those stocks will buy you in the real world. The main trigger is not going to be geopolitical. It's going to be what happens in the U.S. economy. I think if the U.S. economy goes into recession officially and the Fed goes back to QE, I think that's going to be the biggest positive catalyst for gold. I think we'll get above 3,000 next year.
The Federal Reserve cut interest rates as widely anticipated, but Chair Jerome Powell's cautious remarks on the future trajectory of borrowing costs left markets unsettled. Powell emphasized that further rate cuts would depend on substantial progress in reducing persistently high inflation. His comments reflect a shift in policymakers' approach as they factor in the potential for significant economic shifts under the Trump administration. Powell highlighted both the progress and challenges in the battle against inflation. While inflation has eased since peaking in 2022, recent months have shown stagnation, with key components like shelter costs improving more slowly than expected. This tempered optimism sent ripples through financial markets, causing stocks to drop sharply, bond yields to rise, and investors to scale back expectations for further rate cuts in the coming year. Chief economist at Euro-Pacific Asset Management, PeterSchiff, noted that while the Fed may not guarantee another rate cut at its next meeting, it will likely keep the option open. Historically, the central bank has aligned its actions with market expectations, and if markets anticipate another cut, the Fed is expected to deliver to maintain investor confidence. Let's get back to the interview.
Yeah, well, first of all, unemployment rising, the way the Fed looks at it would be a reason to cut, although they haven't even acknowledged any weakness in the labor market, despite the fact that there is tremendous evidence that the labor market strength was exaggerated over the past couple of years, and we've never actually had a strong labor market. It's been weak, and it's getting weaker. But all the other economic data really has been weak, and it's been ignored. But I think the main reason the Fed is cutting rates is because the market expects them to do it. And so the Fed doesn't like to disappoint the market. So if markets expect 25, the Fed's going to deliver 25. Now, the question is, what is the Powell going to do at the press conference tomorrow to try to influence perceptions for the next meeting? And I have a feeling that Powell may suggest that the next rate cut is not a guarantee, that the Fed is kind of taking a wait and see attitude. They want to continue to evaluate the incoming data before deciding on the next move. So I don't know that they're necessarily going to say that, we're going to cut again at the next meeting, but they're certainly going to leave the door open to that possibility. And then we'll see what type of expectations the market develops between now and then based on the incoming data. But the odds are, if the markets build in the expectation of a cut, the Fed will deliver to meet those expectations. But those reports are meaningless because they just downwardly revise them. So you can't put any stock in the initial number, because the actual number could be very different. They could report that payrolls went up by 200,000, and months later they may say, "Oh, they went down by 200,000. We got it wrong." So there's no reliability in these numbers. I don't even think they're a close approximation of what the actual number is going to be. I don't even think they bear any resemblance. It's just a random guess that actually has no basis in reality. Well, I think as the economy weakens and unemployment rises, I think, yes, he will be beating the drums for lower rates and a return to quantitative easing, the same thing that he did when he was president the first time. But the immediate effect, I don't know how much effect he'd have on it right out of the gate. But I know there is a lot of false optimism surrounding Trump and how great he's going to be for the economy. We had similar optimism.
The interplay between monetary policy, inflation control, and economic stability continues to shape financial markets. While cautious rate adjustments aim to manage growth and inflation, the evolving economic landscape highlights gold's enduring appeal as a hedge against uncertainty. With central banks and investors closely watching inflation trends and geopolitical developments, the precious metal's potential for long-term appreciation remains in the spotlight. How will changing monetary policies and global economic conditions impact gold's future role as a safe haven asset? Share your perspective in the comments section. If the video resonates with you, join our community by subscribing to our channel and enabling notifications with the bell icon. Thank you for being a part of our community.